Hi, welcome back to the channel. In today's episode, I want to talk to you about what's happening in the economy in China because the trade data for November has now been released and it shows that China had a fantastic month in November, which at face value you would think is good news for the economy. If we have a look at this chart, it shows China's trade surplus, which is basically the difference between the value of its exports and the cost of its imports. And what you can see here is that in 2025 so far, in the first 11 months, China has broken a new record. Its trade surplus is now above $1 trillion. So it's selling $1 trillion worth more of exports than it's paying for imports. And this was obviously one of the issues that Donald Trump had with China. He was saying that basically trade was beneficial to China and not beneficial to the USA. What this chart shows us is that the rest of the world is basically holding up the Chinese economy by buying all of its goods. And if you look at the shape of this chart, it looks like since 2018, things have been going fantastically well for China. However, as we've discussed many times before, you always have to look into the detail of these stories. Don't just look at the shiny headline that says China has a record-breaking month in November and assume that China is doing really well, because when you look at what's going on at the moment, there are some very worrying trends from China's perspective. In the month of November, China saw a huge fall in its exports to the USA as a result of the fact that Donald Trump has now imposed multiple tariffs on all Chinese imports. So it now costs a lot more for companies to import things into the USA from China. And as a result of that, there has been a reduction in demand and a reduction in orders. This chart shows the year-on-year movement in exports for China over the last 12 months. And you can see that in October, exports actually fell into negative territory. And that was a real concern from China's perspective because the whole economy is totally dependent on exports, as we've just seen from the trade surplus graph. However, in November, there has been a bounce back. Year-on-year exports are up by 5.9%. So you may think, well, that sounds like really good news. But one thing to note about this chart is the trend. And that's why I show you graphs, because they give us a really good flavour as to what the general movement is in all of the different metrics we're looking at. So if you look back to March, when year-on-year imports grew by 12%, at that point, things were looking very exciting from China's point of view. When you look at the trend since March, there is a distinct downward movement here. We are seeing a slowdown in the increase in exports. So that in itself is a concern. And the fact that they fell into negative territory in October raises alarm bells. That's basically telling you that there is something not right with Chinese business at the moment. But when you look into the details as to what happened in November, the biggest single market for Chinese exports is the USA. That's basically the most attractive market for all exporters wherever you are in the world. And in November, China's exports to the USA fell by 29%. Now, that is an absolute disaster. And in fact, the USA has now been overtaken by the European Union as the biggest single market for China. And the reason for that is because of the increase in the prices in the USA. So China desperately needed to move those exports somewhere else. So the European Union has seen a flood of goods coming from China at very low prices. And Emmanuel Macron, who's the leader of France, has come out and said that this is not sustainable. And the European Union is now looking at introducing potentially the same sort of tariffs that the USA has done to protect its businesses. Now, just before we go on any further today, can I ask anybody that hasn't subscribed yet to please hit that red subscriber button? It's not really a subscription, but it really does help me with the algorithm and also puts a smile on my face. But as I said earlier in the video, you always need to look into the detail to see what the economic impact of these movements are. And this chart shows the movement in producer prices, also known as factory gate prices in China, over the past 12 months. And as you can see here, if you look at the scale on the right hand side, which starts at 0 and goes down to -4%, in every single one of the past 12 months, factory gate prices have fallen in China. And we don't have the data for November yet, but the recent data for October showed that it was down by 2.1%. And I've expanded the scale of this chart to show the last 3 years. it's a very worrying pattern from China's perspective because the sales price of all goods has been falling consistently for the past 3 years. And some of these numbers are very large. In some months, it's fallen by more than 5%. So that's a major concern. So, what we are seeing here is that Chinese companies, whilst they're achieving record exports and they're managing to sell things, they're selling them at a loss because they've had to consistently cut their prices despite the fact that their own costs have been going up. They've been seeing higher wage costs, higher rental costs, higher fuel costs, higher raw material costs. But when you've got all of those costs going up and your price goes down, that means that your profit margins are being cut. And I've talked about this many times before, but more than 50% of companies in China at the moment are making losses, and that's not sustainable. There is no point having a business that's got increasing sales but falling profits because somebody has to fund those profits. And where that funding is coming from is from debt. So lots of companies in China are currently taking on more and more debt to keep funding their own businesses to sell at low prices. But that's not an economically viable model. And if we look at this chart, which shows the year-on-year movements in imports, this tells us that there's something not right in China right now. The most recent data for November shows that imports increased by 1.9%. Now that compares to the 5.9% increase in exports. And the reason why imports are important is because Chinese businesses have to import raw materials, which they then use in their manufacturing processes to make things before they're exporting them somewhere else. So if you've got growing exports, you would have expected imports to actually be growing at a faster rate to keep those raw materials coming, to make sure all of these companies have enough stock so that they can meet all of this growing demand. But that isn't happening, and there's two reasons for that. Firstly, this demand isn't real. It's not coming from the consumers. China is forcing its products into all of these markets at low prices. And secondly, Chinese companies don't have the cash flow to be buying in all of these raw materials because they're making losses. A lot of their cash is going into funding those losses and paying interest and repayments on their debt. And one of the other very worrying things from China's perspective is what's happening with retail sales. You can see from this chart the year-on-year movement over the past 12 months. And once again here, the trend is very obvious. Since May, where there was a huge increase in retail sales, where Chinese consumers came out and started spending more, there has been a massive reduction in the growth in retail sales. It's now down to around 2.9%. So that is moving in the opposite direction at the same time as producer prices, factory gate prices, sales prices are going down as well. So Chinese consumers are getting a good deal at the moment, but they're not buying more. If we have a look at what's happening with inflation, the key issue to look at in this chart is the scale on the right-hand side. It only goes from 0.7% at the top to minus 0.9% at the bottom. And if you look at the last 8 months, you can see that in the majority of those months, the prices have actually fallen in China. So they're experiencing deflation at the moment. Most economies are worried about inflation, but actually when you get into a deflation cycle like this, it's worse because all of the companies in your economy are struggling to be able to pass on any cost increases, what we've seen from the factory gate prices. And consumers get used to prices starting to fall. So you would have expected with falling prices to have a surge in retail sales because people think, well, fantastic, there's some good deals to be had, I'm going to take them. But that isn't happening. And the reason for that is because of reducing demand. Consumers are nervous in China at the moment. What's happened in the property sector has damaged a lot of people. They've seen losses in their life savings. They're worried about what's going on with all of their property prices. They thought that was going to be a never-ending gravy train where you'd make lots of profit. That isn't happening. So consumers are worried in China. They're not spending as much. Retail spending is not increasing at the rate that the Chinese economy wants it to. And as a result of this, prices are going down. And this is becoming a really vicious circle from Chinese producers' point of view. And the reason for showing this is that Chinese companies really are now totally dependent on the export markets because the domestic demand just isn't there. And now that the European Union is considering applying the same sort of tariffs that the USA has done, this could be complete disaster from China's perspective. So, what's the summary and conclusion today? Well, I wanted to post this video because I think headlines that you see in the press about China hits a record trade balance, it's got over 1 trillion trade surplus at the moment, can lead you to believe that China is suddenly doing really well. And you think, I've been watching all these Joe Blogs videos, he's been saying China's struggling. What's he talking about? China's actually hitting record numbers. But as I've said many times before, you always need to look at the detail. The devil is always in the detail. And what we've talked about in today's video is that exports have bounced back in November. They're up by 5.9% year on year, which in theory would mean that China would be on track to hit its 5% GDP growth target for 2025. However, when you look at the details as to what's happening, it's a very different story. Over the past 20 years, the USA has been the single biggest market for China. It's the most attractive economy in the world. It's the biggest economy, and it's the one where you earn the best margins. But unfortunately, because of all of the tariffs that have been introduced by Donald Trump, China is really struggling right now. And in the month of November, it saw a 29% fall in the value of its exports to the USA. Now, if you're any business and you're losing your biggest customer, that is a complete disaster. So China has done quite a good job. It's decided that as it can't sell much into the USA right now, it's going to focus on what was its second biggest market, the European Union. And we've seen a 15% increase in the value of exports into the EU in November. So happy days, you might think. However, unfortunately, from China's point of view, the value of those sales is not being translated into profitability because Chinese companies are consistently having to reduce their prices. We have seen 36 consecutive months of falling producer prices in China. So they're constantly reducing the sales price of their goods to encourage more countries to take their products. And that's what's happening in the European Union at the moment. There has been a flood of Chinese products in November. But unfortunately, from China's point of view, this has now raised alarm bells in the EU because EU companies who are having to compete in the same markets are obviously seeing their profits and their sales being wiped out. And the EU doesn't want that. That's the whole point of tariffs, is to try to protect your home markets and your home producers. So Emmanuel Macron has come out and said that this needs to be addressed. It can't go on. China can't suddenly just flood the EU with cheap product and expect to get away with it. We've already seen the EU imposing big tariffs on electric vehicles that are coming out of China. And I think there will now be a full review of all products coming in from China. And it's likely that we will see similar tariffs being applied in the European Union as has been applied in the USA. And if we see a similar slowdown in demand, if it was 29% fall, for example, as we've seen in the USA, that would be a complete disaster from China's point of view because, as we've talked about, domestic demand is waning at the moment in China. Consumers are concerned about what's happening in the economy. There is a slowdown in demand from the market, and we're also seeing prices, inflation going down. It's actually on the verge of deflation constantly at the moment. So the overall summary of today's video is that whilst China has expanded the amount of its exports in November, we haven't seen a commensurate increase in imports. They've only gone up by 1.9%, which tells us that Chinese businesses are not gearing up for a boom period. They're actually using a lot of their raw materials in these production processes to try to bring in some cash. Unfortunately, Chinese businesses are struggling to increase their prices, both domestically and overseas. So the fact that they're increasing total value of sales isn't translating into increased profitability. And actually, over 50% of Chinese businesses are currently making losses. And that figure is rising all the time as we look at this data. And this is all spelling huge problems for China because those companies are having to take on more debt. That's the only way of funding losses, either from cash reserves or debt. They don't have cash reserves, so they're now using debt. That's building up a bigger problem because as you take on more debt, you have to pay interest, you have to make repayments on that debt. That's a further drain on your cash flow at a time when you're making losses. So this is becoming a really vicious circle for a lot of Chinese businesses. And at some point, this debt will have to be paid back. And if you're not making any profitability, you won't be able to do that. That basically means you're illiquid, you're bankrupt, you're out of business. So we've got a wave of bankruptcies starting to build up in China that are going to come home to roost at some point in the future. So hopefully you've enjoyed today's video, you found it useful, informative and thought-provoking. If you've liked what I've said, then please give me a thumbs up. Thank you for watching this video all the way through to the end, and thank you so much to everyone that's supported me. I really do mean this. If you bought me a coffee or sent me a YouTube super thanks, really am overwhelmed with that. Thank you for your generosity. And if you've signed up either as a patron or a YouTube member or a Buy Me Coffee member, thank you. That really blows me away that you're liking my content so much that you're happy to support me. It really helps to keep me motivated. And here's something to put a smile on your face.